Hey everyone, and welcome. I am absolutely thrilled you're here today. We have a seriously exciting explainer lined up for you. We're going to do a complete visual breakdown of Forex trading. If you're a 9-to-5 professional who's always wanted to peek behind the curtain and understand the mechanics of trading, but you've been entirely put off by all the intimidating jargon and those crazy complicated charts, well, you're in the exact right place. We're basically going to strip all of that away today. We're going to build your knowledge from the ground up using crystal clear, simple visual concepts. So, let's just dive right into it.
Now, this right here is the million-dollar question, isn't it? For most working professionals in India, standard stock market hours are just incredibly frustrating. I mean, think about it. The market opens while you're commuting, and it closes by 3:30 p.m., right when you're still completely stuck at your desk. By the time you actually have some free time around 6 or 8 a.m. p.m., the local market is completely shut down. It genuinely makes becoming a trader feel practically impossible. But what if I told you there was an ultimate 24-hour alternative? Enter the Forex market.
All right, so here is our game plan for today's explainer. We're going to cover 1. The Forex market advantage. 2. Forex versus the stock market. 3. Understanding pips and lots. 4. Choosing your currency pairs. 5. Master the market hours. And finally, 6. A simple winning strategy.
Let's kick things off with Section 1, the Forex market advantage.
To really wrap your head around this, just think about the airport currency exchange. It perfectly illustrates the core of Forex. Imagine you're traveling from India to the US. Your rupees aren't going to work there, right? So you go to a kiosk at the airport, then you hand over your Indian rupees to get US dollars, all based on the current exchange rate. Let's say the rate is 84 rupees to a dollar. Boom, you make your exchange. But here is the catch, and this is where it gets interesting. Those exchange rates are constantly fluctuating based on things like geopolitical factors and economic stability. As a Forex trader, you are quite simply speculating on those exact fluctuations. You're trying to figure out if a currency will go up or down, and that's how you make a profit.
Now take a look at this massive number. Just look at all those zeros. We're talking about $6 to $7 trillion. That right there is the daily trading volume of the Forex market. It's just a colossal scale that literally dwarfs almost everything else out there in the financial world. But you might be wondering, why does this massive size actually matter for someone just starting out?
Which brings us perfectly to Section 2, Forex versus the stock market. The crucial difference really boils down to volume and timing. The Indian stock market has roughly 1 to 2 trillion in volume. It notoriously closes at 3:30 p.m., and it suffers from these frustrating things called gaps. You know the feeling, you analyze a stock, you go to sleep, and the next morning it opens at a completely unpredictable, totally different price. That's a gap. On the flip side, Forex boasts that massive 6 to 7 trillion volume, and it is open 24 hours a day, 5 days a week. Because it rarely closes during the week, it is virtually gapless. This is a huge deal. It means you can trade seamlessly after your workday actually ends without that awful anxiety of overnight market gaps.
And because of that sheer size, we get this really beautiful reality. Manipulating the Forex market is practically impossible. In smaller markets, a few big players can easily pump or dump a small-cap stock. But in Forex, no way. You would literally need hundreds of billions or even trillions of dollars injected in a single day to artificially move the price of major currency pairs or gold. For you as a trader, this means reading the charts and understanding pure price action is so much smoother and far more reliable.
Okay, moving on to Section 3, understanding pips and lots. Let's get into some of the mechanics.
First up, we've got leverage. Now, leverage simply means your broker provides you with some extra buying power. It basically allows you to control a much larger position than your actual deposited capital would normally allow. In the Indian stock market, leverage is heavily limited. Sometimes it's practically negligible. But in Forex, it is a completely standard, incredibly powerful tool.
To put that into perspective, standard Forex leverage can be anywhere from 100x to 200x. Let's just do the quick math on that. If you deposit just $100 and you use 100x leverage, theoretically, you are controlling a $10,000 position in the market. Now, we have to be completely objective here. This brilliantly amplifies your buying power, for sure, but it equally amplifies your risk. It's a double-edged sword, guys, and it requires some seriously strict risk management.
But hey, don't panic, because the Forex market actually has this built-in safety net called the stop-out mechanism, or liquidation. Think of it like this. If your account balance is $1,000 and your losses start getting dangerously close to wiping out that exact deposited amount, the broker will automatically step in and close your position.
So, generally speaking, your losses aren't going to magically exceed the actual money you deposited into your account. So how do we actually measure movement? Well, we use something called pips. People make this sound like absolute rocket science, but honestly, it's just a measurement tool. In the Indian market, you might say something like, oh, the stock moved 50 points, right? In Forex, you just say the currency pair moved 50 pips. That's literally it. It just tells you exactly how much the prices moved up or down.
Next up is lot size, which is essentially just your position size. Now here is a golden rule straight from our source material. You should always use a position size calculator about 5 to 10 minutes before you enter a trade. You just plug in your total balance, how much you're willing to risk, let's say 2%, and your stop loss in pips, and it spits out exactly what lot size you should buy. Quick warning though, because of how volatile the market can be, starting with extremely small amounts can get you wiped out quickly. It's highly recommended to start with a minimum of $200 to $500, or, just stick to a virtual demo account until you really feel ready.
All right, Section 4, choosing your currency pairs. Let's filter out some of the noise.
Listen, if you are a beginner, you should strictly stick to the top 3 most liquid pairs in the world. We're talking the euro against the US dollar, the British pound against the US dollar, and the US dollar against the Japanese yen. That's it. Seriously, don't get distracted by all those exotic, complicated pairs out there. These 3 have the highest liquidity by far, which makes their charts the absolute cleanest and easiest to read.
But, and this is absolutely crucial, you have to understand correlation. Think of inverse correlation like gold and stocks. When panic hits the economy, stocks tend to drop and gold goes up because it's seen as a safe haven. They move opposite to each other. Now consider positive correlation. The Euro USD and the GBP USD actually move together about 95% of the time. Their charts look almost identical. So the really important takeaway here is this. If you see a great setup on both of those pairs, you must pick only one to trade. Do not take simultaneous trades on both, or you are basically just blindly doubling your risk on the exact same market movement.
Let's move into Section 5, Master the Market Hours.
You see, the global Forex market is divided into 3 major sessions. We've mapped them out here in Indian Standard Time for you. First, there's the Asian session, which happens late at night. The volume here is incredibly low, meaning the market mostly just drifts sideways. And because it's so thin, sudden, unnatural price spikes can happen really easily. It is highly advised to just avoid trading this session entirely. Instead, you want to focus all your energy on the London session, which opens around 12:30 p.m., and the New York session, opening around 6:30 p.m. That is when the actual global volume really pours in.
And we can actually get even more specific than that. Check out these golden trading windows in IST. The absolute highest volume and the most predictable trend movements happen in the very first hour of the London session, so that's 12:30 p.m. to 1:30 p.m., and the second hour of the New York session, from 7:30 p.m. to 8:30 p.m. This is exactly when the big, meaningful moves happen. If you want the highest probability of catching a clean, directional trade, this is exactly when you need to be sitting at your computer.
Bringing it all together now in our final section, Section 6, a simple winning strategy.
First and foremost, do yourself a huge favor, avoid trading the news. Major economic events, like the NFP, that's the non-farm payrolls in the US, they inject massive, totally erratic volatility into the market. The price will aggressively spike up and then immediately crash down in a matter of seconds. It might seem really exciting, kind of like an action movie, but trading during these specific news events is exactly how 90% of beginners completely blow their accounts. So please step away from the charts when high-impact news is dropping.
Instead of riding that roller coaster, follow what I like to call the ultimate beginner rule of 1. It's beautifully simple, really. Pick exactly one session. Maybe you just stick to the London session. Pick exactly one currency pair, like the Euro USD. Trade only one specific setup or strategy, and as we just said, absolutely ignore the news. If you just focus on one single pair during one single session every day, you'll naturally start to recognize its specific patterns and behaviors in a way that no textbook could ever teach you.
So that leaves us with one final, absolutely vital question. You've got the complete beginner's playbook right here. You understand the advantages, you know the mechanics of leverage and pips, you know exactly which pairs to watch, and you've got those exact golden hours to trade. But actually reading liquidity and truly mastering market structure, well, that takes years of focused daily practice. So the question is, are you disciplined enough to stick to just one pair and one session every single day to master your craft? Something to really think about. Thank you so much for joining me on this explainer today. Keep learning, stay disciplined, and I will see you next time.